All right, ladies and gentlemen, I hope you had a wonderful day. We had a little bit more carnage today, and it was all because of those rate cut odds and data. But surprisingly, the Fed speakers did not have to say much because the damage from yesterday still continued on. So now we got to talk about what's happening, the small caps, and where that rally is going, the data for the rest of the week, and why the strong data is being so pesky, and finally the market is changing its mind. So I got the recap for the day. I have the plays. I got a little bit more info, a couple of earnings, what I need from you, a thumbs up on the video, make sure you're subscribed, and if you don't know, we are live Monday through Friday, 30 minutes before open, youtube.com/thestackmarket. Run it, baby.
Walking to the couch, it's the 2020 last. Live in the hills, but still get a spread. Started with a live, but still reinvest it. Feel how I feel, then you feel like a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but the sound like progression. Farmer never plans if he waits for perfection. Finger to the down, hold it down.
But right off the bat, before we get into the keys, I'm going to give you a little bit of checkup all across the board. You can see where the S&P 500 is. It is hovering right above the level of post-Powell, December 13th. The bond yields went higher again, aka TLT going lower, and once again, the dollar went up. It closed barely lower, but at one point, it was up by 0.3 while we were hitting the lows on the day, and overall, the dollar is still causing a lot of carnage. So that's where we're going to start with, but why did we get what we had today? There was more hawkish talk from the ECB. There was a little bit of it yesterday, but during Davos, ECB President Lagarde, she was saying, yeah, we'll probably cut rates around summer. Why is that not good? Once again, you're getting all of these Fed people across the globe saying they want to cut rates. Even that's what Waller said yesterday, but they are saying it's going to happen later than expected. That is why summer was not good for ECB, because everybody was expecting in the springtime. So not only did you get that, we had strong data here in the United States. The retail sales, that came in good. And like we were talking about, after everything Waller said, that is not going to support things, and I'll explain a little bit, but the cherry on top, not only did you have the central bankers yesterday and today pushing back on these really imminent rate cuts, you even had UK inflation start to go up a little bit hotter than expected, but that's not what anybody wants to see, especially considering our CPIs were just a tad stronger a few weeks ago. So that's where we're going to start with, but a lot of people have been asking this question. They're like, wait a minute, if we're talking about rate cuts still, why are we getting mad if the data is strong? It's very simple. If the data comes in hotter and the data is showing that the economy is not cratering at a fast pace after all of these rate hikes and all of these months of staying higher for longer, it is not giving the need for an imminent rate cut. Pretty much, if you're able to get growth still and the growth isn't falling off of a cliff, it makes sense for people to wait, especially in the central banks, well beyond March to begin cutting, because until you have a real necessary need, a lot of people were thinking, oh, the Fed's admitting they're in a corner now. If they're talking about rate cuts, that means the data is going to deteriorate really fast. We haven't seen any of that. The non-farms, the jobs, the manufacturing, that was one area that went down, but everything else, including the CPI, nothing is showing a quick or dramatic shift that is justifying the 7 rate cuts. Remember, before Powell was speaking, the market was already pricing in 3 to 4 rate cuts, and the Fed was behind that, and then the Fed came in and they said, okay, we moved our dot plot. Powell started caving, so did everybody else, and then the market said, oh yeah, that means we're going to get 7 rate cuts. But now, with about a month since that event has happened, none of the data is cratering faster. The market's getting a little impatient, and now all of these Fed people and even the data, it's pushing back a little bit to this idea that you are going to get a lot of rate cuts. That is the weird dynamic, because you are getting all of these Fed people all across the world. They are talking about rate cuts, and they're still saying, yeah, that is what we plan on doing by the end of the year, but not as fast as people are expecting, and the more or the longer it takes for the data to show up, the market is going to calm down on this whole entire notion. So that's what we got here for 48 hours so far. And the thing I will tell you, maybe this reverses next week and we watch the rate cut odds all go back. It all depends on the data, but for now, this has been the strongest pushback in weeks. Last week, the rate cut odds for March, they were standing at 80%. I believe today, you are standing at 53%. And one thing I had there on the keys, you'll see it when I go back to it, I really want you to think about the non-farm payrolls just a couple of weeks ago. If you remember that day, I even have the watch list. I was telling you how nutty it was because what happened, we had the non-farms come in, and as a result, these same March odds, they dropped all the way down to 40%, but by the time the market opened up, they bounced right back. The difference is we've had about almost a 30% move in the last couple of days, but this time it is actually sticking. So even if you come down in December, these odds are starting to reverse. You could go compare it with the previous week probability, but you see how wide this is. There is still a lot of rate cuts priced in. So the difference is moving forward here now, you got people debating about March, and then depending on how the data plays out and how long it takes, it has to work through all of the December rate cut odds because you are still pricing in a decent amount of rate cuts, with the majority still saying we're going to be at 4%. I believe that is still like 5 or 6 rate cuts. It's not as if you have gotten rid of this big amount of rate cuts, but for now, the market is adjusting to this imminent cut that should be happening in 60 days because that is what a lot of people were pricing in just as of Friday. So that is your first key. I hope it explains some of what's going on and why everybody's still freaking out, even though the market's at 4,700 or above that. But now we got to talk about this because I was telling you about it earlier. We caught this on the move up, but the Russell and the small caps, they are now in danger. Any ideas from the Russells to the regional banks? These are the things that are getting affected more by rate cut odds dropping. Do I think these plays are absolutely over? Not at all, because if we do in fact get those December odds and then we do start seeing cuts, maybe we see a lot in the middle of the year, or maybe you just get that 3 or 4 that was originally priced in, they will be able to benefit. But for now, that hype and this bubbliness that we were getting and these aggressive moves, they are getting in danger now, because if the rate hike odds get pushed back, I wouldn't be surprised to see some of these plays fall off. And if you haven't seen the Russell as of late, this is one of the only asset classes that is now giving up majority of what it was doing on that Fed day. Most things are holding right at the top. The Russell is now down. Bonds and the dollar and other things gave up as well, even gold. But if you look at an index level, NASDAQ and the SPY, they're actually holding up pretty decent when you start to pull it out. So the only thing we got to watch out for here is the Russells in the short term, because you will start having a negative effect there. But now what you need to be looking out for, one, do we start squashing these rate cut odds and does the market calm down? If it does, it'll probably affect those plays. But now the next level, it's going to be those long duration and tech stocks. But are they going to move with the rates in the dollar? Not quite yet. Why? You have earnings right around the corner. How come these indexes are holding up? How come the rate cut odds are pushing back and they're not giving up the same way? One, you have 7 stocks pretty much holding up everything. But two, you have earnings, and after we get their earnings, then the market will be able to move and say, all right, now it makes sense. They don't have good earnings. The rate cuts are up, or the rate cut odds are coming down. They're going to have to deal with this environment. They're not growing the same. Maybe we should sell those and only buy the winners. That is something that we could see in the next couple of weeks. So with that being said, to bring you into tomorrow and the rest of the week, what I'm looking for, you have Fed Bostic tomorrow. He has been bullish lately. He did fight back a little bit about rate cuts and them happening soon, but he was bullish on quantitative tightening. But in general, it does seem like every Fed member has kind of picked up an aggressive tone. But even though we were expecting that, we didn't really get any of that today out of any of the Fed speakers. They all kind of turned into non-events, so maybe that happens. But other than that, you're going to get initial jobless claims tomorrow. Maybe we move around with some of the real estate data. The Philly Fed is probably going to be negative. We'll see if that causes a positive outcome. outcome, but for the most part, I am not expecting that we break the range or recover until we get over this expiration on Friday. There's going to be a big expiration on January 19th. It feels like every expiration has been the biggest one in the time and the options in the total notional amount. It's like we hear that every single time, but I wouldn't be surprised. We saw this at the beginning of last year too. Anytime those expirations get out the way, we start to move, and now with earnings and the big earnings following up, hopefully this all kind of makes sense with everything we said already in this video. I do think that the earnings, they are going to start the carnage up or down after we get out of these expirations, and then we see where it leads us. But that's what I'm expecting. I think it should be fairly simple. Maybe I'm wrong on this, and usually if I'm wrong about staying in a range, that means it's going to move wicked. So we'll see what happens. But now, let us get into the plays. So, right off the bat, I got a couple of different plays, but I got to start with the earnings one because 2 standard deviations has struck in again. We played it on Discover. This one was live intraday, so I was not able to give you an update on the watch list because they literally reported after hours. But the thing about Discover, they move a lot. They have made a big move right now. I think we are in the money on them, or maybe we're like $1 out of the money. Yeah, they're at $98. We grabbed the 97. Again, $12 if you did 2 standard deviations. That's almost exactly where it is, but here's going to be the issue with this play tomorrow. It usually reverses at open. Discover can make some big moves, and it has moved like 8 to 13% on the last couple of earnings, but usually it'll like drop and then have a big pop and then come back down again. It really likes to dance around the place and kill the premium, so this is going to create a great opportunity. We either take profits tomorrow, we either ride it out, or mainly, hopefully, we might be able to get a good double dip play. If the market's distracted with all this rate cut stuff and it wants to move in its own little la-la land, this could be a good one where either the calls will be really cheap in the morning or those puts, they'll get a big value. It'll have that stupid pop, and then those puts get cheap again, and then it continues its way down, and then you start to play out. But definitely give this one a little time because like I showed you on the last chart, it does take like a week or two to really fully realize the move, and whatever happens on earnings with Discover, it doesn't necessarily stay there. So we'll see how that one plays out. But that's play number 1. But if I could give any attention to anything, that 2 standard deviations, baby, that was your first tutorial I gave you this year. Hopefully you put it into good use. But that is play number 1. Then play number 2, I'm still holding this play. I was down a lot, but after today, it did come back up a little bit. But Instacart, and there was a lot of talk today. It was people bringing up mergers. I think it was Wolf Research saying them and Uber would merge. That doesn't make any sense to me because they just IPO'd, and why would they do that? But the main theme I'm taking away from this is that analysts are giving it attention, and if you haven't noticed with some other stocks lately, this has been a big driver. Go look at AMD. That was all analysts. Go Wake Up in the Morning, WDC, and a bunch of other plays. Even though the market comes down, there's a bunch of plays that are still running and doing their thing. I think it's all because of analyst activity. There's a lot of downgrades into earnings that are lowering the bar, and some of them, they've already had their bar lowered, and now they're getting these upgrades to start their earnings run up. This could be one of those situations. So watch out for Instacart. Watch out for any analyst activity in the morning. I really do think this could be a huge driver, but that is play number 2. And then finally, play number 3. I got to bring this back up. We've had some great flips on it this year. It's done very good for us even end of last year, but gold, and it looked very strong this morning, but then the dollar was already up. Opening came, and then it absolutely sold off. So what I want you to watch out for is the dollar to stabilize or the dollar goes down. When that happens, I do think it'll cause a gigantic move in gold. But as of late, if the dollar could just not go up, gold might find one of those days where it can move $10, $20, hold up for a day or two, and then if the dollar comes back up again, it'll give it all back up. But keep your eyes out for this. It is moving back to some of these previous levels, both pre-Fed as well as getting back up to that resistance near 2,100. But if this thing falls below $2,000, it is going to get very interesting. My only play, I have a micro gold. I think I'm down like $300-$400. That was the only one I kept holding after all of those other plays. But in this case here now, I do think gold is going to be interesting. But sadly and fortunately, it's tied to the dollar. But I think that's the big thing that is making this somewhat somewhat of a bumpy ride, but watch out for 2000, watch out for 2010, then 2020, and that'll open the door up to the 2040s and 2050s, and if it does drop below 2000, the next level to the downside will be 1988. So keep your eyes out for that, but that's all the plays for today. As far as everything else, I didn't make too many plays. I did get out of 2 different plays. I had an old MNQ. It wasn't even old. I forgot I did it on Friday. I didn't want to be holding that one because I really wanted it for a flip. I took an $800 loss on that. There was 2 of them, and then I closed out of my March Fed futures. Remember, I was buying those rate cut odds in March, even before Mr. Billy Ackman there, and we had a nice gain. I was up like $500 to $800 on them. They came back down. They're now 50-50 coming back to those levels. I sold out for like just under $200. Said, hey, I'll hold my short on those that I'm still holding. Those are still down, but now if the rate hike odds do give back, they should be able to pay out, but I'm still holding in those plays, and then I think that's the only thing I cut out. I held the TSM. Remember, that was the earnings play. We'll go over it tomorrow live on stream. I gave an update on it on yesterday's watch list, and then we made the Discover plays. I don't know if I went over them, but we played both ways. Again, $12 up, $12 down. That means a 120 call from 108. Grab one for $44, and then I grab one put a little closer than $12 for 49 cents because of the spread and everything else, and spent just under $100 to play that, and we will see where it opens up tomorrow. But Chad, that is your watch list, ladies and gentlemen. Make sure Hydrate Healthy ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And I need you to remember, you need a if not clause. That means you could hope and aspire for a lot of things, but if not, you still gonna be in the game. You still gonna act the same. You ain't gonna change your attitude and be based upon the circumstances, ladies and gentlemen. So Chad, hold to it. Stay in the game. Get that long term. I love you all, and drink that water. Stay hydrated, healthy, all that good stuff. I will see you in the AM and horn.